Right, so we are live. Yeah, okay. Just checking. Can anybody hear and see us okay? There's a bit of delay there, so we had to wait for people. Reach out. Brian. Okay. Hi, Brian. Yeah, okay.
Everyone's come through. Okay, good.
Oh, yeah, we got a few people. Yeah, Daniel, Sabrina, we have Alex, Joyce, yeah. Melvin, hi, Melvin, yeah. Vivian, Akase, yeah. Why? Awesome, yeah. Okay, so we're just gonna get started. I mean, today it's an amazing day. Yeah, it's yeah. I mean, I bet no one actually can predict that. Yeah. So and it's something quite interesting, though, because like at the moment, there's one of my property actually, Housing New Zealand actually looking at to purchasing one of my property, and that's kind of like a, you know, like they kind of for some reason, you know, like they kind of put on hold at the moment. So it's quite interesting, you know, like seeing the announcements comes up and everything. Yeah. But anyway, so we're certainly going to actually go through the, you know, what are the new rules later on. We actually didn't plan this, you know, for the government's announcement. Actually, we booked this, we scheduled this webinar like probably over 2 months ago. Yeah, Tony, yeah, like probably over 2 months ago. Yeah, and we just going to talk about tax. Yeah, so Tony actually going to actually talk about tax. Yeah, we got Thomas there. Yeah, hi Thomas. Yeah, so we're going to talk about tax. Yeah, so just because the announcement, I think is really good, you know, having a chartered accountant with us, you know, so Tony will actually just go through some, I think, apparently, I think the legislation is not there yet. So he will try to give you as much, you know, information that, you know, that he knows, you know, to share with you. Yeah. Okay. So I understand that for some of you that, you know, like for some of you that if you haven't met me before, my name is Lucia Xiao. So I run finance, mortgages, and insurance mortgage, you know, advisory business, and also I'm a property investment mentor. So I'm really focused on trying to actually helping more people getting into their homeownership. And so we run like a one-day workshops, you know, we run a master class, yeah. And I'm really hoping that, you know, my, you know, like because I always having these dreams, you know, I want to go on teaching the young kids, like from the intermediate age, you know, to the college, you know, just the young kids, you know, to understand that homeownership is not that difficult. It can be achieved, you know, easily. Yeah. So I'm hoping that, you know, these dreams will come true this year. Yeah. Okay. So we're doing something behind the scene anyway. Yeah. Okay. So so I'm also the author for the book called Financial Freedom 5 Steps, 5 Years. Yeah. So myself kind of like being able to just investing in, you know, like in property, and was able to walk away from a decent corporate income just 3 years later, and having the freedom allows me to actually run my own business and doing the things I really absolutely enjoyed. Yeah, I got a great team here. I think I have 13 staff, you know, like they all coming from a very good banking background, you know, very experienced bankers. You know, we had Lillian from the ASB business banking. We had Violet from the BNZ commercial banking, and also she was a business partner as well. Yeah, we also have Hans from the ASB, you know, Barry from ASB, Alice from ASB. So it's a very experienced banker in my team. Yeah, and so joining us tonight is Tony. So Tony is a chartered accountant, very, very experienced accountant. Yeah, and also he's so humble because every time when I call him, he always pick up my call. Yeah, so he always make himself available for his customer. And every time, like, because very often when we're doing the application, lending applications, and then suddenly the banker will requesting like, hey, you know, we need this forecast. Hey, we need this like whatever the, you know, the comments from the accountant, and Tony is always able to helping, you know, our clients out. Yeah. Okay. So I'm probably going to just let Tony to introduce, you know, yourself. Yeah.
Okay. Well, welcome everyone. As Lucia said, I'm Tony Thorne. I run Thorne Accounting and have done that for the last 15 plus years. and we just specialise in doing everything related to property for property accounting. I was going to do, I had the slides all prepared for what we were going to do today in terms of structuring, but the government announcement this morning has basically blown that out of the water. So I think I'll probably flick through my slides in about a minute of 2 minutes to say what I was going to say briefly, and then proceed to say why it no longer applies because of what the government has proposed, and then I can go through and take you through what the government's proposed, and then we can have a question and answer session after that. And I can basically try and answer as much as I can. Obviously, the rules are relatively new for me as well today. I'm only coming out this morning, but I'll do my best to answer any questions you've got. So shall I start? I'll start with the slides. Yep.
Start presentation. Yeah, I think I can kick the start. Yeah.
Oh, I can kick that off here. Okay.
Oh, sorry.
Do you take that away from me?
Yeah.
Okay. Okay, so this was the presentation that I was going to do, and I'll just flick it through in about 5 minutes because a lot of it's not particularly relevant anymore. The main objective of most structures that we do in accounting is to optimize things from a tax point of view, which typically means claiming as much interest as possible. The government have announced this morning that that's going to be that's not going to be possible, or they're going to phase it out. So a lot of these structures will probably become obsolete. It may be structuring as a thing of the past. It may be that structuring will only be for asset protection, and we won't really worry about things too much from a point of view of maximizing interest on things. So I'll just start off by going through a few of the slides. So the first thing I was going to talk about the outline of the ring fencing rules, which came into effect last year, and they basically meant that if you had a rental property and it made a tax loss, then that tax loss would be carried forward as opposed to being offset into your income. So that's been in place for a year now. However, going forward, that really becomes more or less obsolete, because if we can no longer claim interest going forward, then we're probably very unlikely to actually make a tax loss, in which case the ring fencing rules become obsolete. If for some reason you aren't able to claim interest and you still somehow make a tax loss, then that tax loss will still be carried forward. So I still imagine those ring fencing rules will still apply, but not many circumstances will apply in there as well. And then I've also, in this presentation, was going to go through and I was going to provide some planning opportunities just around what you could and couldn't do to maximise things from a ring fencing rules point of view. So just a bit about the ring fencing. I pretty much covered that in the last slide. They're basically in force for a year, and I mean you can no longer offset your rental losses against your personal income, and instead they were just carried forward. I guess this is probably reasonably relevant in terms of what properties it relates to. It relates to residential property, and the reason I say it's really relevant is because the ring fencing relates to residential property, but so do the new proposed rules that are coming in. So we've got new proposed rules on interest deductions and new proposed rules on extending the bright line test out to 10 years. They all relate to residential land. And that's very key to know actually what is residential land. In this case, it's residential land. It's land that has a dwelling or could have a dwelling on it, and it includes land both in New Zealand and overseas. So if you've got overseas property investment, that certainly doesn't get you around these rules. But it's clear that it's residential, which is not commercial. So it's residential land in New Zealand or overseas, and that's also. Or could have a dwelling on it. So if you just have a bare section of land that you could build a dwelling on in the future, that's also going to be captured as well. So and then this is just the list of the properties that it doesn't relate to. Commercial property, and again we'll touch on that later because it might be that commercial property becomes more in vogue going forward if the ring fencing rules don't apply to commercial property, and neither will the new interest deduction rules or the 10-year bright line rules as well. So commercial property might become a lot more popular going forward. And there's also other things that the loss carry forward rules don't apply to, are things like mixed use properties such as Airbnb, batches and stuff like that, farms, hostels, and land that's used predominantly as businesses as well. So in terms of planning options, one of the main things we'll be looking at, and again, this will actually apply to both the ring fencing rules and the interest deduction rules is basically, if you have commercial property, is to have more borrowing against your commercial properties and less borrowing against your residential, because at least you'll be able to claim the interest against the commercial properties, and if they do make a tax loss, then it won't be ring fenced. So, but again, that's only going to apply if you're an investor that's got both commercial and residential property. But it may be something that you may want to look into going forward in terms of investing in commercial property rather than just residential. We also looked at the ring fencing rules didn't apply to mixed use properties. Mixed use properties were it's typically the Airbnb batch where the property is rented out plus you use it privately as well, and in that case the ring fencing rules didn't apply. The interest deduction rules are likely to apply to that. I don't have actual confirmation of that yet, but it does state in the ID has stated that they're looking to bring the mixed use properties into the definition of residential property. So it's likely that they will be subject to the interest deduction rules. And then the last planning option is basically the use of trusts. So when we had ring fencing, we wanted to avoid the situation where we had profit-making properties under a trust and loss-making properties in your personal name, because you couldn't offset the two. Again, that's going to become a bit of a moot point now with interest deductibility issues, but there still certainly are a lot of planning options with trusts, particularly now if you're going to have properties that are making big profits. Trusts are going to become really important to allow you to basically the flexibility to allocate the profits to any of the beneficiaries that might be able to pay a lower amount of tax. So we'll come back to those options after I've touched on the interest deduction rules. And then the last slide I had there was we often get questions about what's best. Should we use a look-through company or should we use personal ownership? Again, it's probably going to become a bit of a moot point again. I think with the interest deductibility rules, it may be that look-through companies are used less and less going forward. We've certainly used them a lot in the past, where you might have your own personal home and then you decide to go and buy a new personal home and you want to rent out your old home. In that case, we used to use look-through companies a lot, because we'd transfer the old home into the look-through company, and we were to be able to increase the debt and therefore increase the interest deductions. But of course, if there's no ability to have interest deductions going forward, then again the use of the look-through company might actually fizzle out of it as well. And then the last slide was just about the interest deductibility and the benefit of a look-through company over personal ownership. But again, I won't touch on that because it's realistically become a bit of a moot point from the announcement this morning. So sorry to race through that really, really quickly. I just wanted to get through that because I just figured we'd go through what the structuring was going to be. Now we can touch on what the new rule changes have been, and I can show you as to why this restructuring is going to become obsolete and what it all means going forward. So, 9 o'clock this morning, the government announced they were going to make some pretty drastic changes to residential property. From an accounting point of view, the two main changes were, one, they were going to extend the bright line test. Currently, it's 5 years. So that means if you sell a residential rental property within 5 years of purchase, then you pay income tax on the gain. They announced they were going to extend that from 5 years out to 10 years, and that would apply for any properties purchased from the 27th of this month. So it means that that means that as long as if you are buying in the near term, as long as you've got a sale and purchase agreement that is unconditional by the 26th of March, then you'll only be covered by the previous 5-year bright line test. But if you go unconditional on a property from the 27th of March going forward, then you'll be covered by the new 10-year rule. They have said though that they are going to make new build properties exempt from that new 10-year rule. So going forward, there might be a lot more investors buying new builds than existing stock. So that's a bit about the 10-year rule. That one was that had been earmarked that it was likely to happen. So I don't think that came as any great surprise. But what did come as a big surprise, I know some people had had said it might happen, but no one really thought it was going to, was the government removing the ability for investors, for residential investors, to actually claim their interest deductions against their rental income. So obviously, in the past, we've had a property that might bring in $20,000 of rent, and you might have $15,000 worth of interest and $5,000 worth of rates and insurance and repairs. Therefore, 20 minus 15 minus 5 equals 0. So you had zero profit, and there wouldn't be any tax implications at all because there was zero profit. Going forward, though, they're basically saying that $15,000 interest deduction will no longer be available, and therefore that property will now make a $15,000 tax profit. And that'll be taxed at if it's under your personal name, that'll be taxed at your personal tax rate, which could be, say, 33%. Therefore, you might have a $5,000 tax bill on that property now, whereas previously you didn't. So the rules here are, again, any properties purchased from the 27th of March going forward, you will instantly be disallowed, or you will be disallowed any tax deduction from the 1st of October this year. For existing properties that you already own, those interest deductions will be phased out over 4 years. So as an example, from the 1st of October this year, the interest deductions will be reduced down to 75% of what you'd normally claim, and then it'll be 75% of that for the next tax year, then 50% for the next year, 25% for the next tax year, until you get 0% of what you previously had claimed. There is a suggestion that new builds will be exempt from that interest deductibility, which again would be a massive advantage for new builds, but we're not sure on the detail around that. The document that the ID released today basically said that, look, these are the proposed rules. There is no detail or legislation around that yet, so we don't actually have the details. And regarding the new builds, they've said that there will be consultation regarding an exemption for new builds on that interest, but there's no further details around that in terms of what actually constitutes a new build. What about existing new builds, or is it only for new builds that you purchase in the future? So there's still a lot of unknowns about that. I'm hoping, though, of course, that the new build exemption will apply to both existing new builds that you purchased maybe a few years ago, and also to new builds that you purchase in the future as well. Yeah, so it's all been a bit of a shock for a lot of people. So what I thought I'd do here is basically try and get a few questions coming through from the chat, even with perhaps some examples in there, and we can actually go through and actually explain as to how it actually might affect an investor, so you can actually maybe get an idea of how it might affect you and your situation as well.
So we got this one from Lee, so saying like not being able to deduct interest payments will be a biggie.
Yes, absolutely. So if we go through an example, a typical investor, let's say you buy a property for, $1 million. Let's say you're lucky enough to have a 40% cash deposit, and borrow 60% of that, so you borrow $600,000. And your borrowing rate at the 1 year rate is 2.29%. So $600,000 at 0.29, you've got about $14,000 worth of interest. So basically, in the previous scenario, you might have been rent that out at, say, $800 a week. So maybe you get $40,000 in rent, and you had $15,000 worth of interest and maybe $15,000 worth of other costs. So you had a $10,000 profit on that property, and you paid tax at, say, 33%. So in the previous scenario, you would have paid $3,000 a year. In the new scenario, you cannot claim the interest on that roughly $14,000 worth of interest. So therefore, your tax bill is going to go up by about $4,000 or $5,000. So basically, the tax impact is largely going to be the interest on your mortgage multiplied by your personal tax rate. Will be by and large should be roughly what it cost you.
So shall I just do something here? So say like a 600K, and then comes because it's 2.29%, right?
Yep. So that's 13,700.
And then also like your tax rate. So say like if it's your tax rate is 0.33%, yeah. So that's actually what you're missing out. So that's what you missing out. More or less. It might be that. For example, if you had a situation where, let's say, you had a property and it brought in $20,000 worth of rent,
and let's say hypothetically your mortgage, your interest was $20,000 as well, and you had another $10,000 of other costs. So previously you would have made a $10,000 loss, which was carried forward. So in that scenario, if the interest deductions are removed, then your $20,000 rent minus your $10,000 other costs would leave you with a $10,000 profit on which you're going to pay 33% tax. So in that case, because you were in such a big, large loss position before, the tax impact on you won't be as big. So it really does depend on whether you're in a loss position prior to these rule changes, or whether you're in a break-even or a profit position prior to these rule changes.
So, I mean, it really depends on how you're viewing it. I mean, like, when I'm seeing that, I don't see a lot, it's because it's the $4,500. Yeah. So what? I mean, when you look at weekly, it's $87 a week.
Yeah, absolutely.
Yeah. And then it has, at the end, when you look at the value that you are adding, the capital growth there is still a great investment, because, and don't forget that we already have a much benefit on the low interest rate. Remember, like, a year ago, we probably had to paying like over 4%, sort of things like that. So it's actually been offset because we actually paying less, less interest. We already having this great benefit, and then now we missing out. You missing out this because the interest rate cannot be deductible. So that's the message they are trying to get you to understand. Is like that it's actually, yes, obviously there are some impact, but don't forget that we also already paying a much lower interest rate. Probably like compared to 2 years ago, probably 4.5% or something, sort of things like that. So we already getting a great benefit here anyway. Yeah.
I think what I'm telling my clients is that, look, if you've got $1 million property and it goes up by 10% per year, then you're at $100,000 extra equity. If it's going to cost you an extra $5,000 or $10,000 in tax to hold that property now, then you're still obviously significantly better off. But I guess the crux of it is that they've still got to be able to afford the cash flow as well, because it's all about cash flow as well. So so clients that can afford to hold the properties and they've got to swallow the extra tax they've got to pay, and that's unfortunate for them. And they'll still do well over the long term, considering the property prices go up. It's those people that are flying a bit closer they don't have as much cash flow. Those are the ones that are going to struggle a bit more, and they may have to make some hard decisions about whether they can afford to keep their property or not if they're a little bit tighter on cash.
Yeah. Okay. So I hope that we answered that. And okay, we got Brian question here. So what is the land acquired date in the new policy? Is the agreement signed off date or the settlement date?
Yeah, well, according to the document here, I've got that it says a property is generally acquired on the date a binding sale and purchase agreement is entered into. So we're talking about binding, effectively means unconditional. So we're talking about the unconditional date as the date that it's been acquired.
So say that if the offer been made, but if they haven't been agreed, before the 27th, that means that they fall under the new rules, is it?
Yes, that's my understanding. Yes. Yep.
Okay. All right. Okay, and then we've got. I think Tatiana kind of trying to answer that. I believe it's when you sign a sale and purchase agreement, or most likely even unconditional. Yeah, you're quite right. Yeah. Okay. Nassim was answering Brian's question, and then when you enter into the contract.
Yeah, I've got another one here. I've got a question here from John. What is the best structure to minimise the tax for rent profit? So basically, the question is, what is the best structure to minimise tax going forward from here? I think trusts are going to become very, very important here. I think for two. The idea is that you probably have to accept that there's going to be profit on your rental properties. So once you've accepted you're going to have profit coming from your rental properties, you want to be able to pay the least amount of tax on that profit. Therefore, you want to be able to allocate that profit to whoever can pay the least amount of tax. So if it's a husband and wife scenario, you'll want the ownership to be under the person earning the least amount of income, so they can pay the least amount of tax on it. If you're a single person, there's probably not a lot you can do about it. The other scenario is having a trust involved as well. Trusts can be really good for providing flexibility of distributed income. The way a trust works is that if a trust owns a property and it makes a profit, you can distribute that profit to any of the beneficiaries in any way you want, and you can change that from year to year. So depending on who and it can be the husband and wife, or it could be, you could also potentially use your own children as beneficiaries as well if they're age of 16 or more, and you can allocate that profit to any of those beneficiaries if they're on a lower tax rate. Trust will also become very important if someone earns more than $180,000. From the 1st of April this year, the tax rate for people earning over $180,000 is going up to 39%. So you don't want the rental property going to the rental profit going to that person. You would much rather the rental profit going to either a spouse that earns a lower amount, or you want to go into a trust, and that trust can either distribute those profits to whoever can pay the least amount, or it can leave the profit in the trust because the trust tax rate is still 33%. So I think trusts are going to be, I think trusts are going to become a bit more popular going forward. Having said that, and on one hand, I will say on the other hand that it's becoming harder and harder to restructure your affairs, because if you've got properties, say they're under your personal name or under a company, and you want to transfer them to a trust, well, you've now got the new 10-year bright line rule. That means that you transfer it to your trust, you actually have to wait 10 years before you sell that property to avoid paying income tax on it. So the bright line test just makes it harder and harder to restructure, because it means you've got to hold on longer and longer, because those tests will restart. So it does make it harder. So even though there may be ways to restructure things, you've got to seriously consider the risks if you do it, because if you sell within 10 years, that could be really costly as well, and may undo any potential savings you might have otherwise had.
Okay. We also have a question from Jackie. So how about interest against the residential property for commercial property investment?
Yeah, so the security of the loan, from my understanding at least, the security of the loan is irrelevant. It's all about what the funds are actually used for. So for example, they've actually got an example in here where a person they draw down a loan against their residential property to purchase a business. And in that case, they clearly say the intention is they want to make that tax deductible, because the purpose of the loan is for business, even though it's secured against residential property. In Jackie's case, she's talking about the interest is, I'm not sure if she's saying if it's borrowed for the purpose of buying a residential property. No, she must be saying that it's secured against residential property, or commercial property investment. Again, you would look at what the purpose of the loan is for. The purpose of the loan is to buy commercial property, and because commercial property is not covered by these rules, I imagine that would be tax deductible. That interest would be deductible in that case. So again, it's more about the purpose of the loan as opposed to where the security comes from.
Okay, so Louis, with commercial being exempt, does that include the properties that are considered commercial for mortgage purpose? No,
the definition of whatever the definition of commercial and residential is for lending purposes is completely, it's separate to the definition of what a residential property is for the income tax purposes. We can forget about what the bank is telling you, whether it's commercial or residential. It's residential rates or commercial rates. We're more concerned with what the definition of a residential property is for income tax purposes, and that is before. It's a residential property that has a dwelling on it or could have a dwelling on it, and that's whether it's in New Zealand or overseas. There is going to be a little bit of, it's going to be tricky when I've got clients, for example, that might have a company or a trust, and they've got some residential property in there and some commercial property in there. It's going to be very interesting as to how we go about allocating. So if we've got lending under that same company, do we say that does that lending relate to the residential property and therefore not tax deductible, or does it relate to the commercial property? So there's no rules around how that's going to be, how it's going to be allocated at this point. But I guess we have to wait for the detail on that a bit more. But certainly that would be a potential tax-paying opportunity that we'll be looking into to see if we can allocate more of the interest to a commercial property than a residential.
Yeah. And question from Richard: can I sell the property to a limited company with market price, and let the limited company make loss, as it still can claim the interest? So the interest, the fact that interest is not tax deductible is tied to the fact that it's a residential property, regardless of whether it's under a company or a trust or anything else.
And I will touch also on the fact that, I mean, obviously we can think about different things such as selling properties to a different entity, maybe to a trust, for example, to maybe utilise lower tax rates. But we've got to be very careful about the bright line test. For example, the property already may have been acquired only, say, 3 years ago. So if you transfer the property, it's within 5 years and it might already be subject to the bright line test. And if it's not already subject to the bright line test, you've got to be aware that by transferring it, it's going to restart the new bright line test, which is now 10 years. So you've got to be very careful about transferring properties now as well.
Okay, question from Thomas. Does today rules set on stone rule or still have a consultation period?
Yes, there's still a consultation period, but my understanding it's more around the details of how it's going to work. I mean, I can't see any. The actual concept behind it all, and the fact that the 10-year bright line is going to 10 years, and the fact that we're going to have interest deductibility removed within 4 years for existing properties and immediately for new properties, that will not change as far as I can see. It's more just around the consultation around how it affects new builds, how it mainly about how it affects new builds, definition of residential property, the definition of some of these things around it. But that's just, it'll be tinkering around the edges. But I'd say so the vast majority is going to happen.
And I think you answered a question from John. What's the best structure to minimize the tax for rent profit? Yeah. Okay. The next one is from Joe. I hear that interest non-deductibility also applies to any refinancing of your own old property.
Again, there's an interesting one. Again, so I think there was probably lacking clarity in what we've got so far. But what Joe's getting at is that the document that the IDF released has said that you cannot claim the interest. If the document here has said that you can't claim interest if the money has been borrowed to maintain or improve property. I guess I'm thinking that from Joe's scenario, we're not talking about borrowing money, additional money to maintain or improve a property. We're talking about refinancing existing debt, i.e., repaying $200,000 and drawing down $200,000 with another bank. So I'm hoping that when the details do come out, the simple refinance of a loan going from bank A to bank B with no increase in the actual balance at all will still be tax deductible for at least the next 4 years as it phases out. But I don't have a definite answer for you on that one there. That would be one of those things we'd look at for the consultation.
Okay, and we got question from Vivian. So LTC will still be useful in such case if the directors are of different tax bracket?
Absolutely. So if you've got husband and wife as an example, and one earns more money than the other, one's not working and one is in a high tax bracket, then obviously having a vehicle that will allow the profit to be allocated to the one earning no income or the least income is going to be so much better. One of the ways to achieve that is using a look-through company where the person earning the least income might be the 99% shareholder, but obviously there's different ways you can achieve it. So you could do it through a look-through company where the lowest earning person has 99% of the shares. You could do it just through, one person could just buy the property in their own name outright under their personal ownership, or you could put the property under a trust, and because the trust, you can distribute the profit to any of the beneficiaries as well. The downside of using the look-through company or the personal ownership option is that once you've put it in those ownership percentages, you're basically locked in. And if your situation changes down the track, if one person gets a job and the other one stops working, you can't really flip the situation around. So you're basically stuck with what you've gone with in the first instance. Whereas with a trust, it's more flexible. You can change the beneficiary distributions from year to year. So depending on how your income situation changes, then you can actually change the distributions as well. So a trust is going to be, trust will certainly be my number one preference at this point. And then probably a look-through company would be number two in terms of splitting income like that, splitting the profit.
Right. Okay. Oh, it's very intense. Yeah. Okay. Good question from Brian. So, if I'm doing renovation or development on my property, could I do this interest deduction?
So that's, I guess that flows on from what Joe was talking about. So if you actually borrow funds for that renovation or improvement to the rental property, and you borrow those funds from the 27th of March onwards, then no, you will not be able to claim interest on those deductions.
But development, no?
So,
Or development,
or development on the property.
Mm.
Yeah. So no. If it's a residential property, no, there will no interest deduction for that. It's basically deemed to be, I guess it's sort of deemed to be like a new property being purchased if you have to borrow additional funds for it. So they're saying you're caught under the. It's as if you've acquired that property from the 27th of March, which means you don't get interest deduction.
But what happens if you buy a property, existing property, residential property, you bought an old house and you build a terrace house, a new build there?
Yep, if you do that.
So that's a new build now, isn't it? It's exemption.
You're talking about if you did that after the 27th of March or before?
After, yeah.
Well, ultimately, I mean, if you bought a property after the 27th of March, you're effectively, regardless of what you do with the property, you don't get any interest deduction.
Oh, right. Okay.
Yeah.
But how about? So how about the money that you borrow to develop the new builds?
Yeah, so what they're saying, so if you bought a property after the 27th of March, then obviously interest is not tax deductible. If you have a property prior to the 27th of March, but then you borrow additional funds after the 27th of March, thus, according to this, because you're borrowing more against that property, they are saying that is not tax deductible, that interest, because that's effectively like you're adding on to the property itself. So effectively, the additional borrowing is deemed to be almost like you're buying a new property after the date. So I still say no, you won't be able to claim that interest.
Okay. All right. All right. We got a question from Nassim. Yeah. So can the government overrule what accountants and the tax authorities defined what is and is not deductible as an expense?
Well, that's right. But the government are the ones setting the rules. So the government are the ones setting the legislation of which the tax authorities, being the IRD, will follow. And that will be what us accountants will also follow as well. So, I mean, they're not overruling anything. They are basically providing us with the rules on which to follow. If there's any grey areas, I guess that's where accountants will be there to, make sure the client takes advantage of those grey areas. But if it's fairly black and white, then we'll just be following what the government has set out, and that's what the idea we're following as well.
Okay. We got a question from Amy. So if we subdivide our property to build I think that's probably the same question, to build a few new units, will that be considered new build category?
Yeah, well, this is, so I'll read out what they've got as their, so again, there will be consultation on this as to what the definition of a new build is. But at the moment, the rough outline of a new build, it's a property that it includes properties that are acquired within a year of receiving their code of compliance. So basically, if you already have an existing property and you've owned it for a couple of years, and then you decide to do a new build, new units on there, that will not be classified as a new build because you've already owned the property for a year before the CCC is issued for the new build. So no, that won't be classified as a new build as far as I'm aware.
I guess we might want to part it because I think they're still going through the consultation.
It is good to go.
And once that's available, we will invite Tony back just to actually explain, because I think now even then, they're still waiting for this, because it's not the legislation yet. Yeah. So I think we're going to wait and just part this one for now. Yeah. Okay.
Yeah.
All right. So Mimi, we got a question from Mimi. So how about if you have multiple properties on 100% loans? Yeah. So basically, it depends on how much your total mortgage.
Yeah, well, if you've got multiple properties, assuming we're talking about all multiple residential properties, and assuming they're all purchased prior to the 27th of March, and none of them are new builds, for example, I'll say that's my assumption on this one here, and they're all got 100% lending on them. It basically means that interest on that 100% lending will be phased out over the next 4 years. Today I was just discussing things with 2 or 3 clients that I have that had, they contacted me because they actually had sort of 10 to 20 properties. The ending was, around the $2 or $3 million mark. And so up until now, those properties have been close to break even. and now that client has, one of those clients in particular, for example, he was claiming $300,000 in interest deductions that he will no longer get. So all of a sudden he goes to, his break-even properties are now $300,000, making a profit of $300,000. So he's going to have a $100,000 tax bill each year, and he now has to make the decision how he's going to pay for that, whether he's going to have to, whether he's got enough income coming in to actually pay for that, or whether he has to actually sell one or more of his properties to pay for that. So you might be in a situation like that, where you've got multiple properties, lots of lending on them. It's going to hurt it's going to hurt your situation a lot, unfortunately.
Okay, we got a question from Akshay, is it?
Yeah.
How long is a tax deduction available for new builds?
Well, as far as I'm concerned, all it just says is the new builds will be exempt. So I'm hoping that'll be forever, as long as you hold that property. Bearing in mind, of course, it still says here, consultation will cover an exemption for new builds acquired. So again, there's still going to be lots of consultation around that. Maybe they'll only do it for a certain period of time. Maybe they'll do it indefinitely. We don't know. Fingers crossed that'll be indefinite, but I don't know. Speaking of, because I'm wondering if it'd be quite an interesting dynamic when you've got someone that's bought a new build, and let's say hypothetically that maybe you do get interest deduction forever, and let's say you hold that profit, and the 10-year bright line doesn't apply to that. It's only the 5-year bright line test. So let's say that property, that person buys the property and they sell it after 5 years, so they're outside the bright line test. It's going to be quite interesting, because they'll buy that property from a developer, and there'll be lots of interest in those properties, presumably because investors will want to buy properties that they can have tax deductible interest against. But when he comes to on-sell that property in the open market, the purchaser will no longer be able to claim the interest against that, because effectively it will become existing stock to them. So it might be a lot harder to resell all of these properties that are bought off the plans, because the subsequent purchaser won't have the same interest deductions as the original purchaser. So that'll be quite an interesting dynamic to see that play out as well.
Okay, so a question from Alisa. So does putting existing properties into a trust trigger blind line and 100% tax?
Yes, very well could do. Yes, so if you've got existing properties, they very well could be subject to the current. So if the current 5-year bright line test started back in March 2018. So for example, let's say you purchase a property in March 2019. Therefore, it's subject to the 5-year bright line test. You've only owned it 2 years. So therefore, if you transfer it to a trust today, you would be subject to the bright line test and have to pay income tax on that. So yeah, if you're currently within that 5-year time frame at the moment, you certainly wouldn't want to look at changing anything around. If, however, you have a property and was purchased prior to March 2018, so let's say you purchased in March 2017, that will be outside the current bright line test at the moment. So you could transfer it to a trust without triggering any income tax, but you have to realize that by transferring it into a trust, it would restart the new 10-year rule. So you then have to hold it for 10 years to avoid further income tax. So you just two things to consider there.
Okay. All right. We got a question from Spencer. Yeah. So can you analyze the new policy's impact on the bank's home loan criteria? Will bank loosen or tighten their lending criteria?
That sounds like a broker's question.
Yeah. Anyway, we haven't heard anything from the banks yet, and I had to be honest that with all those the policies changes, you just have to take it easy, because obviously what you can see now is they're trying to cool down this market. But don't forget that before, when the market is actually going up, that people that actually, the homeowners, they feel like, oh, my house price is going up now. They were actually willing to spend money. There are people, they simply just top up the mortgage and then they renovate the house. They want to buy a new car, they want to buy a new boat. They spend money. I think that all those car, I had customers, he's a car dealer. He said, just really busy. And don't forget that when they started tightening up, that cash flow will disappear, because people they don't want to spend money. Okay, and you don't forget that we are still we actually haven't get out of the COVID-19 crisis yet. The economy is not recovered at all. We are only on the recovery. We are not recovered yet. So just have to understand that those policies it can keep changing. And again, the bank, their credit policy, at the moment, we haven't heard from anything. When the bank, they are started, not lending much money, obviously their profit is going to be hurt. They're going to have so they probably had to keep changing something. I don't know. Yeah. So basically, just take it easy and then just wait to see. Yeah. Okay. Okay. We got a question.
I'll try and get this done by 8:30, so I'll try and flick through a few questions reasonably quickly. So I've got Sean here. He's saying that is the tax law a law that might be overturned by a different government? I guess he's talking about national there. Anything's possible in terms of whether they could. Whether they would, though, I still think it's unlikely that they would. At least at this point, Labor's seem to be doing something about the property market, and I don't know that National want to be unraveling what they've sort of been doing. But who knows? I guess we'll have to wait and see what National come out and say. Matt says, what happens around tax for development of new properties, for developing new properties and hold? I don't know if you're talking about if you're talking about buying off the plans. Then obviously, hopefully, that all the new rules they're going to be exempt from the new rules. Hopefully, if you're just talking about if you bought a property and you were intending to maybe remove a dwelling or maybe put an extra dwelling on there and doing some sort of subdivision or anything like that, you would still fall into the residential property category, and I think you'd be subject to the interest deductibility rules as well. Anthony says, can you sell the property to a trust for the same amount to get around the bright line test? Yes and no. Technically, you are expected to for tax purposes, you should be selling properties at their current market value. So while you could sell it at an artificially low value, you do run the risk of the ID potentially challenge that at some point in the future, and that wouldn't. It's a bit of a risky thing to do. I've got Anne's here, but it says private beside it. What does that mean?
How does how does the interest deductible change impact investors' borrowing power? Will the banks become stricter in scaling rental income? At the moment, there's no, no changes from the bank policy. Yeah,
it might be something you'll have to factor in at some point, because it's a decent cost. So.
Probably, yeah. But we just at the moment we haven't got any changes from the bank yet. Okay. These asking if I have 3 dwellings on my property and I live in one, so basically it's kind of like a unoccupied home income type. It's got 3 dwellings there under one title. Yeah.
Right. Okay, and he's living in one, and whether those rules apply to it. That's a good question actually in terms of mixed. So I guess we're talking about mixed use properties in that case. They haven't actually said anything about mixed use properties at this point in time, so I'm thinking that'll probably come out more in the consultation phase of that, I think. But I'd imagine that I guess again I'd be surprised if they left that as a loophole in which to claim interest. But that'll be something that'll come out in the consultation. I don't know the answer to that one. Yeah.
Daya is asking if I run a room or boarding in residential property.
Yeah, that very much leads on from Lee's question, really, in terms of all these mixed use properties. If you're having, if you've got mixed use properties or flatmates or boarders and that sort of flatmates, how's that going to impact? Answer is I don't know at this point. Actually, it hasn't actually touched on that in the ID document. So that's something we probably have to wait for the consultation period when they have a bit more detail around.
However, if you are running a boarding house, that's a commercial. That's different. Yeah.
Yes, that's right. There'll be. Yeah, I think she might be talking. I know she's talking about a boarding house there, or just having boarders in her own personal home. So a boarder, if it was a total boarding house, that'd be a commercial property, and that wouldn't be subject to the new rules. But if you've got boarders in your own home, when in fact, if you've got boarders, often they're exempt for, if it's under the thresholds, they're exempt for income tax anyway. So it's probably more like if they've got flatmates.
Yeah. Okay.
So Iris says, so for loans after the 27th of March, does it include refixing with the same bank or refinancing to another institution? Yeah. So I think in that case there, again, I don't think it's clear. I mean, clearly in these documents are saying if you borrow more for improvements, then that interest will not be tax deductible. But they're not specifically clear about what would happen if you simply just refinanced one bank to another bank for the same lending, so the lending doesn't actually increase. I'd be surprised if you would lose the phasing out period because of that. But hopefully that'll get confirmed in the consultation period as well. Then we've got Susie's got lending for new construction builds. When it's available for rent, can this be considered as new build and potentially exempt? So lending for new construction. Yeah, well, that'll be right. So whether it's, I guess, a lot of people buy a new build as a turnkey, but you might be buying a new build as where you settle on the land and then you build the new construction for that. So as long as it fits into the criteria, which is getting CCC within a year, and that criteria will be a bit more ironed out. As long as you still meet that criteria, then you can potentially be exempt from that as well. Amy says, ID said the date.
They will, is it?
I'm not sure. Said the date is based on the binding agreement date. Does it mean the sound purchase agreement date? Well, I believe the binding agreement date will be the unconditional date. So the binding agreement date is basically when neither party can exit that agreement. So I would think that'd be the same as the unconditional date. What about all the cost of renovating? Is it still deductible? Well, technically, even before this, if you're doing a major renovation that was improving the standard of a property, that could very well have been capital in nature previously anyway and not tax deductible. So it was only actually repairs that were tax deductible before this. So I mean, ultimately that hasn't changed. If you spent repairs on a property, they are still tax deductible. If you did major renovations that were improvements, they would still be not tax deductible. So nothing's changed in that respect. It's the only way to get around this to take the government to court and challenge new ruling. Hey, by all means, go for it. Try your luck. I guess you can always badger your local MP and do whatever you like there. The investors associations, all those sorts of bodies that are going to be lobbying to maybe get this withdrawn, or at least in the consultation period, trying to make it maybe a bit less draconian. But by all means, have a go. Richard says, can you explain about the interest deduction rule and the timeline and percentage for the different periods? Yeah, so for properties for existing properties that you already own, you get 100%. You can claim 100% of your interest up until the 30th of September this year, and then there's an 18-month period where you can only claim 75% of your interest, and then another 12 months where you can only claim 50%, another 1 year where you can only claim 25%, and then therefore from the 1st of April 2025 onwards, you've got no interest claim at all. So you've basically got four tax years until you have no further interest claim. That's for existing properties. For obviously newly purchased properties, you get no interest deduction from the outset, or at least from 1 October. If the property investor will pay taxes from now on, will that mean that rental rates will increase as the vessels need to pay the tax they pay? Yeah, well, that's the argument that they're putting out there, saying that if you bundle more costs onto property investors, then theory is that property investors will offload those costs onto tenants. I guess time will tell as to whether that will happen and at what extent that will happen. Jeannie says, if we bought a property for development purposes after the 27th of March, can it be considered as developer lending to deduct interest costs? Well, it depends on what you're doing with that development. If you're doing the development to develop an on-sell, then you're a developer, and therefore you pay tax on the profit, and therefore you can claim all your costs, including interest. If, however, you're developing to create rental properties that you're going to continue to hold as rental properties, then your interest will be limited. Sarah says, can I buy a new house that I'll live in and rent out the current house so the rental property can deduct the interest? So can I buy a new house that I will live in and rent out the current house? And that's what used to happen a lot in the past. So people would buy a new house and they'll rent out their old place, and to get interest as tax deductible, they would sell their old place to a company, and we'd increase the debt on the old place and therefore claim as much as possible. That will no longer be possible going forward because it's still a residential property, and there won't be any interest deduction on that, so that will basically no longer be possible. Johnny, if I buy a property under my personal name and or nominee and go unconditional on it on the 27th of March, firstly it has to be before the 27th of March, Johnny, so it has to be 26th of March or before, anyway, and then we nominate my trust to complete the settlement. Will this come under the old rules? No, nominations, they'll have rules that say, well, if you're nominating someone else as the purchaser, then we'll go back and look at the first unconditional date. So just remember, that'll be the 26th of March, because it has to be, because it has to be before the 27th of March.
Yes.
Brian says, what if we're borrowing a construction loan category from the bank and do a development on the land? Well, again, it depends on what that development is, what you're referring to, because it's clear that if you're an actual developer, which means you're actually constructing properties to on-sell, and therefore you would pay tax when you sell those properties, interest is tax deductible. But if you're actually doing a development on the land to create rental properties and to hold those long term, then that will still be a residential property, and therefore the interest will not be tax deductible. It doesn't. In terms of what the category the bank puts you in, again, that's irrelevant from an income tax point of view. So don't get confused as to the bank may put you in one category, but for income tax purposes, it doesn't matter. Cheryl, if I apply for a new loan tomorrow, the application is 24th, the $600,000 for development, and the loan approved after the 27th, the interest will be deductible or not. Well, again, it depends on what you mean by development. So if we're talking about if you're going to do a development in terms of creating more rental properties for holding it as long-term rental properties, then it will still be residential in nature. So the rules will still apply. So I guess it really depends on what. So I presume in this case you already own the land because so you already own the property, and if you're borrowing, I would think that if the loan is drawn down after the 27th, I would think that you're going to run into problems. I would think it's all to do with when the loan's actually drawn down as opposed to the application date. Because I mean, I guess the legal dates are only relevant for when you're actually acquiring a property, not necessarily actually for lending. So my comment, I don't know the exact answer to that. It might be wrong, but I would think that it'd be the 27th in terms of, or at least when the loans are actually drawn down would be the relevant date in that case. Spencer says, do you think this new policy may be abandoned in the future once National wins election? Personally, I don't. I think they'll continue with it, but you never know. Lobby away, lobby your National MP and stuff, and see what happens. And that's only on the assumption that National get back in. By all accounts, Labor are still riding high in the polls. Not necessarily because they're doing a great job, but certainly because National haven't been doing a great job. So until National get any sort of traction, I wouldn't pin your hopes on that at all. Lewis, can I put the mortgage in my name and the title in my wife's name? Yes. Well, I mean, that's obviously, I guess first thing is
the bank won't give you the money because the title and the borrower have to be the same. Yeah.
Okay, so I'll leave that one. So we'll go past that one. Anthony, can you maximize tax deductions by maximizing maintenance on a property? Absolutely, and I mean that's never changed. So if you've got a lot of repairs and maintenance to do to a property, you can absolutely do those repairs and maintenance. And as long as they're genuinely repairs, then they can be claimed. You've got to realize that repairs is reinstating a property to the condition it was in when you purchased it. It is not doing work over and above that. It might improve the property over and above the condition it was in when you purchased it. If that's the case, then there could be improvements and might be capital in nature. But certainly if you've got repairs to do, by all means, that'll reduce your tax bill. Can I convert the house to a boarding house? Again, it will depend on the nature of the property, because even though you might run it as a boarding house, if it's still residential in nature in terms of it, because the definition of a residential property for tax purposes is simply that it's residential in nature, and it's just simply a residential land with a dwelling on it. And you may change the use of the house, but if it's still ultimately residential underneath, you may still be caught by the residential rules. So you'd have to look carefully at the definition of a residential property for tax purposes in that regard. Glenn, bought land with a house, was going to build 2 more in addition to the existing. Will the 2 new builds be exempt? Well, I guess it depends on when you bought that house. So you bought land with a house on it. So again, the new build exemption, going back to the definition there, where was that? New build exemption was basically we get CCC within 1 year of acquiring that. So that's probably a more specific question. You have to look at when that land was purchased. You have to get cracking on those new builds right away, I imagine, because it doesn't give you a lot of time. So you're probably going to be tight with timeframes on that one there, but it could potentially work if you're quick enough. Richard, did you mention if I'm not
increase?
Increase. Did you mention if I'm not increasing the loan for the property purchase before the 27th, even if I refinance in the future, still can claim interest deduction as long as the long-term loan is non-credit. So what I'm saying is, I think that if you just refinance like for like, if let's say it's an existing property, you refinance like for like, I still think that that you'll still be able to get interest deduction on that. It'll just be subject to the 4-year phase out, as opposed to not being tax deductible at all. So even if you refinance, you know, a $500,000 loan for a $500,000 loan on existing property, you're still going to be subject to the phase out. So what I'm saying is that, whereas if you refinance $500,000 up to $600,000, for example, and you borrowed more, then that additional borrowing that would not be tax deductible right away. Whereas the initial stuff would at least just be phased out over 4 years. Joe says, if we bought a property before 2018, we're now buying a new build where we're planning to live. If we put the first house into a trust, then will it reset the bright line test? Yes, it will. So you've got a new property that you bought in, that you presumably lived in. So the bright line test won't apply to that one. When you transfer it into the trust, there'll be no problems when you transfer it into the trust. But once you transfer it into the trust, the new 10-year bright line test will restart on that. So if you were going to do that, you'd have to be very, very confident of holding that property for at least another 10 years. Otherwise, you could be stuck with income tax on that. And I'll just go with the last question from Brian, last one there. More like a strategy question. My purpose is to develop land and rent it out and sell it after 10 years. Should we tell the ID that my purpose is build and sell, so I could deduct interest in GST and bypass income tax as well? Well, I guess that's always a possibility. The risk with doing that is, firstly, as soon as you get into that criteria, you may end up paying a lot more tax than you would in any case, because effectively, let's say you buy the property for about $1 million and you spend $1 million developing it, so it's $2 million, and you get to claim all the interest over 10 years, but after 10 years it's worth $4 million. Well, you have to, because you bought it as a developer, you have to pay income tax even if you sold it after 10 years. So that's not good. So it means that you've got a $2 million profit on which to pay tax, plus you've got GST as well. So ultimately, you can end up paying a lot more tax in that scenario anyway. So that wouldn't end up as how you'd like. Because I think the thing you've missed there in that question there is that if you claim GST on a property, it's because you purchase it as a developer. And if you purchase it as a developer, there's no 10-year rule. It's just, even if you hold it for 20 years, you're still going to pay income tax. And that's the problem with that strategy there. So I think that's covered off everything. About 8:30, so yeah, it's pretty good timing.
Yeah.
There's obviously lots of questions, lots of interest on that. So
So
there'll be a lot more coming out in the media and assets over the next few months. We can get more detail on some of these questions as well.
Yes, yeah. So I think Tony, actually, we actually got a couple of files that we will email to you guys. So I think it's actually just like from IRD, the private.
There were a couple of facts that the ID issued out today. So Lucia, if you could forward it to everyone on that list there, they'll answer a lot of their questions as well.
Yeah. And also I got Tony. So if for any of you want to get hold of Tony, I actually put his contact detail. So you can actually click on the link there. Will take you to their contact page. Yeah.
Okay, thank you.
I hope your page is working. Yeah.
Yeah, I'm pretty sure. We'll see.
Yeah. All right. Okay. I think that's quite a heavy duty tonight. Yeah. All right. Okay. Awesome. Yeah. So thank you so much, everybody. And for some of you who are following us, we actually got an event coming up next Wednesday. Next Wednesday night, I think Tim actually going to share with you how he actually quickly increasing his property by $700,000. Just in a quite a short time frame. Yeah, and now he's actually able to quit his job, and he's actually set up his own business. Yeah, so it's quite good, to see that the customers actually being able to having the freedom to do stuff that they really enjoy. Yeah. Okay, and thank you so much for Tony spend the night with us. Yeah, and thank you for everybody. And I shall see you in the future.
Okay,
yeah.
everyone.
Okay, thank you. Bye.